at an example. Just trying to find the right page number for the right example. Oh, it's not there. Hang on, wait a sec. Just give me a moment. Oh, there it is, sorry. It's on page 30. On page 30. Yeah, so it's right in front of my eyes. It's on page 30. Now, I'm being a little bit naughty here because I haven't really told you how we account for derivatives. I've simply said that derivatives are things like options, swaps, futures, forward contracts, that they are financial instruments that derive their value from the price of something else, that they're entered into at little or no cost. Please could you have a read of page 30? Please could you have a read of Spandau? Discuss the accounting treatment of the inventory and the futures contract in the accounts of 31st December X5. Spandau has inventory of a precious metal. Let's say it's gold. Let's say they're a jeweler. So they have got an inventory of gold. But it could be an oil trader who's got oil. It could be a business, which is, anyway, it doesn't matter. Yeah, I'm assuming it's gold. Now, this gold cost 9, but the value of the gold is 12, and this is in October. Now, the entity is risk adverse. It is worried that the market value of its gold will fall. Now, if the market value falls, then they will suffer some kind of a loss. In order to hedge, in order to cover, in order to insure, in order to hedge the risk of the fall in the value, it enters into a futures contract, which is the derivative. It enters into the futures contract to sell the gold for 12. So this contract is now our derivative, because this contract will be entered into at little or no cost, designed to be settled at a future date. At the year end, the fair value of the inventory has fallen by 1 million to 11. The derivative, which was entered into at little or no cost, now has a positive value of 1 million. Because if you are hedging, if you're engaged in a risk management process, then if the risk gives you a loss, then your hedging instrument will give you a gain. So as the gold falls in value, giving you a loss, the derivative rises in value, giving you a gain. And the idea is that they will be offset. The idea is they will be paired one against the other. So the reason this company has taken out a derivative is as an insurance, is as a cover, is as a hedge, is as a risk management process. But I'm jumping ahead. I'm getting too excited. The requirement of the question talks about there being the accounting treatment for the inventory and the accounting treatment for the derivative. Where should we start? Should we start discussing the derivative or should we start discussing the inventory? Yeah, inventory. Yeah, please keep it simple. How do we value inventory? How do we account for inventory? Lower of cost and net realisable value. What did it cost us? 9. And what's it worth at the year end? 11. So what are we going to have in the accounts? 9 or 11? 9. Lower of cost and net realisable value. So, first things first. Keep it simple. Start with the easy stuff. Inventory is at the lower of cost and net realisable value. Inventory is at the lower of cost and net realisable value. Derivatives. I'm jumping ahead. Let me slow down. I'll make a recap note of this when we're done. There are two basic ways that you account for assets. We have a mixed measurement system. So these can either be at cost or they can be at fair value. PPE can be at cost or fair value. Financial instruments can be at cost or fair value. What do you think about derivatives? What will be the consequence of having it at cost? What was the cost? 0. So if the cost is 0 and we have it at cost, then the derivative is invisible. The derivative is simply not accounted for, and there's an unrecognised asset and there's an unrecognised gain. So the standard mandates, the standard requires that we must use fair values. Just like agriculture, just like ISA 41, just like agriculture, we must use fair values. So derivatives must always be at fair value. So therefore the derivative is a 1 million asset. Yeah? The cost is 0, but the fair value is 1. We are always going to use fair value. Derivatives, fair value. Derivatives, fair value. Sometimes that might be described as being marked to market. The phrase marked to market is meaning that you're marking it to market value, level 1, market value, fair value. Now, the cost is 0, but the fair value is 1. The cost is 0, but the fair value is 1, therefore there is a gain of 1. Do you think we should put the gain in the P&L, or do you think we should put the gain in the OCI? The answer is I don't know, and the answer is it depends. Step back. The reason we have got the derivative is hedging. The reason we've got the derivative is to protect us from the fall in the value of the gold. Are we recognizing any loss in the accounts in respect of the inventory? Cost was 9, cost is 9. No loss is being recognized here. So because no loss is being recognized in the P&L, I haven't got a match in the P&L, I therefore take it to other comprehensive income. I take it to OCI. There is a gain of 1 to be accounted for. Spandau is using the derivative. Spandau is using the derivative as a hedging instrument. Spandau is using the derivative as a hedging instrument. Spandau is using the derivative as a hedging instrument. This is a cash flow hedge. This is a cash flow hedge. The risk being managed is the fall in future cash flows and does not impact the P&L. This is a cash flow hedge. The risk being managed is the fall in the future cash flows. In future, when we sell the inventory, then the loss will appear. But we haven't got the loss in this year's accounts. So this is a cash flow hedge. The risk being managed is the fall in the future cash flows and does not impact the P&L. It does not impact the P&L. Therefore, the gain is OCI and will be recycled. Therefore, the gain is OCI. Therefore, the gain is other comprehensive income and will be recycled to match in P&L in the future transaction. So hedging is a risk management strategy. Hedging is a risk management strategy. And what you're doing with hedge accounting is you're trying to pair. And because the loss on the inventory was not in the accounts, because we kept it at 9, so the fall from 12 to 11 is invisible, although we are having to take the derivative at its fair value of 1, we don't take the gain to the P&L because there wasn't a loss in the P&L, so we take the gain to the reserves for OCI, and then we will recycle it back to the P&L when the transaction occurs. I would like to recap. I would like to recap. Or, maybe a better way is to say I'd like to explain again. You always have derivatives at fair value. You always have agriculture at fair value. Investment property, you've got a choice. PPE, you've got a choice. So we have a mixed measurement system. Now, derivatives are always at fair value. When we buy a car, I think that our car is going to be PPE. But in theory, if you were buying a car for trading purposes, if your business was a car dealer, then you would be involved in having an inventory. You'd be involved in current assets. So there are two reasons why you might buy a car. To keep it, PPE, to trade it, inventory. And they're accounted for in different ways. PPE, non-current asset depreciation, inventory, lower of cost and net realizable value. Now, I have mentioned one reason why we have a derivative. I have mentioned one reason why we have a derivative, and the reason that we've got a derivative, the reason that I've mentioned, is to hedge. So it's a risk management. It's a risk management process. You're covering, you're insuring. What's the other reason? Well, why else might you have a derivative? Okay, right, pens down, 2 minutes, pens down. Let's talk about oil. Let's talk about oil prices, okay? Now let's imagine I've got a view. Let's imagine that I think oil prices are going to go up, all right? That's my perception. I think oil prices are going to go up. Now, one thing I could do is I could go and spend $100 million and buy $100 million of oil, but that's really expensive. I haven't got $100 million. Because if I buy $100 million of oil and the price goes up, I would then become a bit better off. But I'd have to put an enormous amount of capital in there. So one way of thinking about speculating on the price of oil is actually not to buy the oil, but to agree to buy the oil at a fixed price in the future. So I could say in 3 months' time, I will buy the oil for 100. Derivative. No money changes hands. I have entered into a simple contract to buy the oil for 100 in 3 months' time. I'm buying it from you. You're going to sell it to me. You've got oil in the ground. You want to fix the price of what you're going to sell at. You're worried perhaps the price of oil is going to go down. I think it's going to go up. So I agree to buy from you oil for 100. Tomorrow, next week, the price creeps up to 101. I have a contract to buy the oil from you for 100. The price is now 101. Am I laughing or crying? I'm laughing.
the value of my derivative is